Well, why don't we begin? So welcome everyone. Thank you for joining us for today's webinar, the second in our Build, Buy, or Partner series. This with Elliot Parker of High Alpha Innovation, Lizzie Francis of M13, and Jason Brooks of Co-Created by Prehype, and moderated by friend of Radicle, Dave Knox. My name is Stu Willson. I'm CEO of Radicle. Before I hand it off to Dave and our panelists, a bit on why we're here. I believe that investing in the future has never been more important, but doing it effectively is very hard. And we want to share perspectives and best practices and learnings from those on the forefront of big company innovation in service of making it a little bit less hard. So who are we as Radicle? And this is not a marketing webinar, as I said last time, so I'll be super quick. Radicle is a research and insights business that helps many of the world's leading companies, customers like Nestle, IKEA, Eli Lilly, Silicon Valley Bank, and many others make faster and better informed investments in the future. And we do that by identifying and uncovering the latent expertise and domain experience of startup leaders on the forefront of new markets. A quick webinar plug. On April 6th, we're launching our Startup Spotlight series with Roy Taylor, CEO of Riff, startup that's developed AI-enabled digital product placement technology that allows brands to scalably integrate their products and logos into film and television, including OTT libraries. If you're interested in the future of brand marketing, I'll drop the invite into the chat. And with that, we are excited to have Dave Knox moderate this session with Elliot, Lizzie, and Jason. And rather than spend a few minutes and a few more minutes introducing them, I'll hand it to Dave, who will kick us off and let the panelists introduce themselves. Dave, this is your show. Thanks.
Perfect. Thank you, Stu. Well, welcome to the show, everyone. This is probably the most engaged I think I've ever seen a group of webinar participants on the question that you sent in advance. So I want us to dive right in because I want to get to as many of the questions that you guys submitted as possible, because that's what makes us the most useful. So why don't we start off with having all of the panelists do a quick introduction of who you are, what's unique about the approach of the venture studio that you're with, and just quick, who are a couple of the companies you work with. So why don't we start off with Lizzie?
Thank you, Dave, and hello to everyone on this webinar, both panelists and everyone who submitted some fantastic questions. I am a partner at M13. We're based in Los Angeles and New York, and M13 is a venture engine. We have both a consumer tech fund, which is a $200 million early stage investment fund in areas where we see consumer behavior transforming. And we have 11 operating partners who are all former founders and entrepreneurs. So we bring our expertise to very early stage founders with our all of our own mistakes that we've made and our deep empathy and our expertise across a variety of sectors. And in addition to the venture engine, we also have our Launchpad, which is our venture studio, and we'll dive into a lot of our learnings throughout this webinar. But certainly what we think makes us unique is our ability to build great founding teams who then have access to the ecosystem as part of our venture engine of investors, talent, partnerships, and we believe this allows them to scale quickly and efficiently. And we've built up and learned quite a bit through our own frameworks and operations over the last few years. And because of our track record, and especially around D2C, we see this as a real advantage in the startup ecosystem. 60 seconds just on my background, besides being a partner at M13. I have a background in consumer technology, both as a former founder operator, but also on the venture side. I started my own venture firm, investing in very early stage consumer tech companies. I've been really fortunate to work at some great consumer brands. I was the CMO at Gilt Group, the COO at Goat Group, which is the sneaker marketplace, and a founder at Textile, which is a fast fashion brand in Los Angeles. And more than not, I was a marketer and operator and helped these companies scale from 0 to 50 million or 250 million to $500 million. And I really truly believe that the power of data and technology and innovative marketing solutions helps companies at all parts of this scale, helps founders accelerate up that J curve more quickly and create connection with their consumer.
Awesome. Thanks, Lizzie.
Yeah.
Let's go down to Jason.
Great. Thanks, Dave. Likewise, it's kind of honored to be up here with everyone else. So appreciate being invited. My name is Jason Brooks. I'm a partner at Co-Created with Prehype. I'm based here in San Francisco. We have a presence here in the Bay Area, New York, London, and Copenhagen. A little bit, just set it up. Background for me, been in and around fintech, been part of the founding team of a couple different companies. Had one that was acquired by Incom. Was at Cardlytics for a while, kind of in the early days of that. And I kind of think similar to like everyone else at Co-Created and at Prehype, we sort of all come from that entrepreneurial background, and I've also done work inside that the corporate space. And I sort of was, as I was reflecting coming into this, I was thinking about a project we did for B of A that was board approved, that had all the love in the world, almost unlimited money, and yet like the first call we got on that had like 250 people plus from B of A for like R3, and it speaks to like that problem of like the corporate kind of that corporate side. Even something that gets so much attention and support and love can just be overwhelmed when they bring 250 people to a kickoff call. A couple things about our firm. We really think about we think about the venture studio space and like building things with our corporate partners. We've been at this for about 10 years, and we really sort of, for us, it's always looking at what do we think is the outcome of the thing we're building. Is this something that's going to go out in the market and spin out and need to raise external capital? Is it inevitably is more likely going to end up back inside and be a spin in and stuff like that? And so when we think about, and kind of our approach is really like, how do you build the right team and the right comp structure and kind of align all the incentives to have success based on where we think this thing will be in 12, 18, 24 months from now. Work with a range of corporate partners, like everyone else up here, some great names, but sort of like just a sample of like do work for Citibank, IKEA, Munich Re, Diageo, and other partners that are out there. So thanks again for having me.
Awesome. And batting cleanup, let's go with Elliot.
Hey everyone, nice to be here. Appreciate the opportunity. I'm Elliot Parker. I'm the CEO of High Alpha Innovation. And my background is in corporate ventures, corporate venture capital, startups, and for many years worked at Clay Christensen's strategy and innovation consulting firm called Innosight. High Alpha is a 6-year-old venture studio based in Indianapolis, and with a focus on B2B SaaS companies. We've raised just under $250 million that we're deploying through our venture fund or through our studio. We've launched over the last 6 years, 28 startups. We've invested in another about 3 dozen on top of that. Last year, as we've gotten better and more efficient at this, we're faster at launching companies. Last year, we launched, depending on how you count, 10 or 12 startups last year. So about a new company every 4 or 5 weeks is kind of what the machine can do at this point. And a year ago, we spun out this company called High Alpha Innovation that I run with a fantastic team to make this studio model accessible to partners. Our goal is to go launch more companies, as many companies as we can. And by working with large corporations and universities, we think it's a great way to do that. So I'm based in Indianapolis. Our team at High Alpha Innovation is around the country. And we've worked, a dozen plus over the last year, dozen plus Fortune 500 companies to create startups together or to create new venture studios that can do that systematically with them.
Perfect. Thank you, everyone. As you can see, we've got an amazing group, and it's going to make this discussion a lot of fun. As we dive in, I always think when we're talking about this space, it's good to level set. So I'd love for one of the panelists to kind of take an approach of what is a venture studio and what is co-creation? And how do you think these models differ from traditional incubation? Just one of you jump in.
Happy to define at least how we think about what a venture studio is. For us, it's the combination of a build function plus a source of capital, which is different from a startup studio. That's the build function without capital. You combine that investment ability with the build team, and that becomes a venture studio. And in our view, we like to think about this on a 2x2 in terms of if you've got accelerators, incubators, venture capital funds, and think about the axes on a 2x2 being capital invested and support provided. The original days of venture capital, investors back in the the 70s, say when this was all starting, would roll up their sleeves, go sit down at a desk with a telephone with the company they just invested in and get to work. And over time, as venture capital professionalized, that became less true. And so now venture capital is I'd say in some ways more passive, deploying capital professionally, but less involved in the support of the companies. And so you've got, they're all in on putting in capital, maybe less so on support. Incubators and accelerators heavier on support, less so on capital. A venture studio, I think, is deep in both, putting in capital and the support to launch these companies. At High Alpha Innovation, we consider ourselves co-founders in the companies that we're launching. We're deeply involved with the founders we bring in, helping these companies get to scale as quickly as they can. So that's the first part of the question. I didn't talk about the co-creation. I'll let somebody else jump in for that part.
Gotcha. Lizzie, Jason, who wants to take it?
Yeah, I mean, I'll take a run at it, right? Given our name is co-created, right? So I mean, we think about co-creation a lot, in a lot of the work we do is, I would say, at the heart of it, it's how you're going to build something with a partner. How are you going to access what the corporate has, which is usually access to insights and access to distribution? How do you take advantage of that kind of, those two key things? Capital is often much easier to find, either sometimes inside the corporate or externally. And so for us, it's at the heart is, okay, how can I get access to those insights? How can I get access to the distribution? And then build a team. And often that team may be a mix of resources from the corporate partner as well as externals to essentially go execute it. So to me, when you say what is co-creation, it's like, how do I take sort of best from the internal, best from the external, bring them together for a higher probability of success on that venture than either one of those by themselves.
Yeah, no, I think both well said. And I think to add onto the co-creation part, in terms of that build versus execute, that's really how we think about it. We have great partnerships both with PGV, Procter & Gamble Ventures, as well as PepsiCo. And the access to, in P&G's case, their incredible IP and their incredible research. It's how do we access that and take the best of that? And then how do we take what we do so well, which is find these great founding teams and then just help them execute at incredible speed and with excellence. I think it's where those two meet and collide that the co-creation differs and becomes something special.
So now I want to dive in. When we look at the world of corporate innovation, it can tend to be a roller coaster, and companies go through different phases across their time period. When you engage with these different companies, how do you see the engagement as a venture studio and co-creation differ from, let's say, the early days, bright and shiny, to maybe a time where you're having to reboot the efforts, the first efforts maybe didn't work? How do you see it change over the years of the history?
I'm sure. Go ahead, Liz.
I mean, so our relationships are, I would say, relatively nascent, perhaps compared to others on the panel. So I can speak to our experience with PGV. And, I think going into it, we had the expectation that we would evolve together. And I think setting those ground rules was pretty important in the beginning because, at M13, we truly do believe in the idea that many ideas and diversity of thought actually creates better outcomes. And so for us, I think it was the willingness to find a partner that we could actually build together with and, take 2 steps back to take 5 steps forward. So for us, it was setting that, as the basis for the relationship and understanding, what's the right operating system and cadence that we can build so that we can have effective conversations around that, and then pivot quickly, right? When we felt that things were not moving fast. We are 2 years in, touch wood, so we're still new at this, but in the spirit of the space that we play in, we do move quickly and together as a team to get the best outcomes.
I'll say for us, innovating inside a large corporation is really hard. And it's in fact, it's getting a lot harder. We've done quite a bit of research on that to try and understand why it's getting harder. And traditional approaches aren't working as well as they used to, right? Now the venture studio is a very effective approach when deployed well, but it's also not a silver bullet. and it's not a standalone thing. It's part of a portfolio of tools, or should be, right? When we're working with large companies to generate a set of ideas and go try and turn some of these things into external ventures, maybe 20% of the ideas we generate are addressed well through a venture studio model. 80% of the things are things that they should just be doing internally inside the big company, or doing with another partner. Maybe a startup's already doing it. Maybe there's an acquisition out there they should go do. It's not a, the important thing is to be deploying a portfolio of tools. I think if you look historically at big companies, they transformed. If you look at actual real examples of transformation, moving from one business model to a new business model over time, that was done either through radical technological innovation through internal R&D and or through M&A. And R&D and M&A are both more expensive and harder to execute now than they used to be, and getting harder by the day. And so you've got to find additional new ways to do it in a world where everything is more distributed, decentralized than it used to be. We believe that big companies have to leverage the power, the learning ability of startups. That means partnering with them. That means buying them. That means being a customer of them. It also means launching them and creating them from scratch. And when we co-create with these big companies, that's to us what it means. Our goal is to drive learning and optionality for the big companies through the vehicle of startups.
And I think that your question, Dave, or the question around like engagement at points in time, I think what we've seen, and certainly even interested other people's thoughts on this, is like, if it's brand new and somebody's just starting off, we're going to start a new innovation practice inside of the corporate. They're often trying to figure out, what do we do? There's a lot of like, I don't know, a lot of euphoria, a lot of excitement. We're going to do all these kind of things versus maybe somebody we've engaged with who's 2-3 years in, candidly has probably burned through a bunch of money. There's going to be some type of management change, or could be a new executive taking it over. But the heart, at least what we believe at the heart of any of those situations, is really with the corporate part, understanding decision making. How are they going to make a decision when presented with, do we invest or not invest in it? Because that's where we see a lot of these things often break down. And so if I were to say like, how do we engage differently with them? If somebody's just starting, you're really talking about, well, how will you make decisions? How can I run tests with you? What if I brought you X? How would you decide on Y? And try to like do real examples of like testing it. If they're several years in, it's understanding where in their decision-making process to go forward or not go forward with things did sort of things break, and then understanding why and putting some of those pieces back together. Because so often, I mean, that one of my common themes around this, and we often have it up on the wall when we used to have the office, which was momentum is oxygen, and when momentum gets sapped, you lose oxygen. When you lose oxygen, you lose the ability to really to hit the market.
So building on that point, Jason, what do you think the top traps are that you see corporate innovation teams falling into? That oxygen and momentum's probably a key one, but what else do you see beyond that?
Yeah, that's a great question. So I would start off with top traps are being super clear as to who can make decisions on what and when. And I know it seems kind of basic, but like, no kidding. If we're gonna invest, cool idea, we're now gonna put $1 million on that. Is that this team? To Elliot's point, what if it's actually an investment you want to go make in a new startup? Is that a totally separate team and a separate governance unit and a separate thing? Until somebody actually stress tests that, they don't know. I mean, and so we would talk about, I would talk to the heart of like the common trap is not thinking about that next decision we're going to have to make, either if this is going well or not going well. And I always like to talk in examples, but we had a large bank. They had something, we wanted to do a comp structure that would align the incentives of the founders with the concept. That had to go all the way to the full governing board of this bank. And we're talking about $1 million, right? I mean, they burned more in board money thinking about this thing than the decision, but no one had really thought that, oh my gosh, we're a bank and we can't have an independent comp structure until that day arrived. And so we learned from it. We try to test those kind of things. So I would say top for me would be looking ahead at what decisions are sort of coming up around that, number one. And then number two for me would be of top traps is thinking in terms of more of a cohort and what I'm trying to do around a thesis versus getting wedded to the single thing, right? Like when people just get focused, we're doing one thing of X. If that isn't working out right, that can be sometimes as a failure versus our thesis was right. We're in the right area. We just need to keep cycling around it. So that would be my two top traps that we try to avoid. And it's not perfect, right? We still fall into them as well, but we try.
Perfect.
I build on that.
Yeah, jump in and add your point. And I want to put a pin on that comp thing, because that was one of the questions from the audience. So let's circle back after Elliot and Lizzie.
Yeah, I'll hit that a little bit too. And I think the fundamental challenge that big companies, fundamental mistake a lot of big companies make is assuming that innovation is an execution challenge and not a learning challenge. And what I mean by that is as a company scales and grows, it develops systems and processes and incentives and the right talent to execute that business at scale. And scaled enterprises are designed to eradicate risk and variability from the system. That is what they do well. That's why it takes so long to make a decision about incentive plans, because it's risky, it's different. We're gonna make sure we eradicate any risk or variability. That's what it's designed to do. And to then say, okay, now we're going to carve out a team of you. We want you to go innovate and do things differently, but you still got to use our HR system. You've got to make decisions the same way you've always made decisions. And you're competing for dollars with the marketing team that's going to go get an ROI, next week by doing an advertising campaign, whatever. Like it doesn't, you can't take the systems that you're using to run that scaled enterprise. They're designed to eradicate risk and say, okay, now go take on a little bit of risk, go make mistakes with all the same pieces. It doesn't work. And so, and that's especially true of transformative innovation that's further away from the core business. And so you can do that to some extent with things that look like what you do today, right? It is an execution challenge. Just go execute, build a spreadsheet that predicts what's going to happen over the next 12 months and just go do it. When we're talking about building new things, fundamentally new things that are different, you can't build a spreadsheet to predict what's going to happen. You can't use the same incentive system. You can't use the same talent. You can't make decisions the same way. Now, the good thing is that startups, on the other hand, are designed expressly for that rapid learning and for disrupting, and have in place the right governance and incentives and access to talent and all those things. So our view is these more transformative types of innovation are better pursued outside in a startup than they are inside a big company. The startups are actually better positioned to win because it's a learning challenge, not an execution challenge. And this goes all the way to the heart of how these things get funded too, which is another big mistake we see scaled enterprises making, the way that they fund the innovation.
Elliot, you just say things so beautifully, but yes, I couldn't agree with both Jason's incredibly practical and excellent advice around kind of governance and the hurdles that it throws up, as well as I think if you are, so let me add a spin to Elliot's, which is just, I think there's a cultural mindset too. So you have to go in with this co-learning expectation, because the reality is you cannot de-risk everything. In fact, to your point, if you're used to predictability and precise forecasting and a perfect formula, it can just seem culturally so uncomfortable to be in that startup world where the founders are moving fast and breaking things and ruthlessly prioritizing in a way that may seem illogical, right? To people who are used to having more time at least culturally, it's accepted to have more time to make decisions that way. So I think the only thing I could add is having that co-understanding that culturally, that's going to be a little uncomfortable, but if you go in with the spirit of co-learning, then and some really good practical advice on the things you need to think about, it can remove a lot of the friction and inefficiency.
So let's talk that comp piece a little bit more, because whether it's venture studios or corporate venture capital, that's always such an unknown question of how to answer. And let's face it, I've had several friends at venture studios that all of you work with that are now on the startup or the venture world because that comp side couldn't get figured out at the corporation. What's the advice that you give to your clients when they think about the comp structures that come from maybe somebody in a traditional brand management marketing role, and then people that want to take that risk and move into something that it does have a tremendous potential upside?
Yeah, happy to start. So, I mean, it's one of the hardest things, right? Like at the heart of everything we're talking about here, and to Elliot's point about the corporate risk, it's all about aligning incentives, right? The organization, a big corporation, is the incentives are aligned to reduce risk. That's how you drive shareholder value. That's how you do. So if you take that all the way down to the individual, and you say to yourselves, how do I get this small team or this person that maybe has an idea? or I want to lean into it more. How do I incentivize them to potentially take more risk and then feel like they participate, so they don't just walk across the street and go start it, right? Like one of the stats, and some of the people that know as well as I throw it around, is like something like 70% of founders will tell you they got their idea at their last job, right? So the ideas are there. It's not the idea, it's not the thing, it's the actual, they left because they didn't get the support they needed. So to try to answer your question, how we see it in practical terms are, I think it's a mix of a couple different things you need to sort of think about. One is, how can I create synthetic types of upsides, which may or may not be actual stock, but like phantom stock, bonuses on key metrics, but things that start to look similar to like what an early team or a founding team would start to see. So how do I create synthetic pieces around that? And then what I actually think is part of the value of the corporate is then, how do I actually bring potentially a little bit of like the landing pad or de-risk it? So how can I actually make this better than going across the street and trying to get your go get your own fund to raise some venture money? And that is, I can give you similar or access to similar types of upside through some synthetic methods or something like that, number one. And two, I can still tell you that if it doesn't work out, you're not trying to figure out how you're going to put food on the table in 12 months, 18 months or something like that. And every company is different. I mean, I would say there isn't a magic bullet. There isn't like, oh, take this comp plan, plug it in kind of thing. It's like every company has to work through how they think about incentive and how they structure it for their teams.
Yeah, I'd say we're a little bit extremist on this point. I've seen some good approximations within big companies where you try to get close to what happens out in the wild in venture funds or venture studios and startups. But what I see is there is always a cap on the upside and on the downside. And what I mean by that is, if it's being done inside a corporation, whether you're running a new venture or running a venture studio fund, you can't make more money than the CEO next year. I mean, come on, right? That won't fly. At the same time, hey, if this thing doesn't work, you're going to have a job in 12 months, and it kills it. Startups are hard enough to make work. And my view is that the binary outcomes in startups are incredibly motivating. Both on the upside, meaning if this works, I may never have to work again. And on the downside, if it doesn't work, I may not be able to pay my mortgage. Both of those are motivating incentives. And so when we think about launching new ventures and doing so with corporate partners, there's a question around how the entrepreneurs or leaders of new ventures are incentivized. There's a separate question around how the leaders of a venture studio, corporate venture studio, are incentivized, which are two different questions, but with the same types of considerations. Our view is that, try as you might to approximate what happens in the wild with startups inside of the company, you can't. And if you really want to recruit world-class founders to get these things going and to make that new venture have the best chance of succeeding, you've got to launch it in the wild and do it as an investor. Take an equity stake and see what the entrepreneurs can do. Get world-class founders in there, see what they can do with the right incentives. Now, the question around how do you do this with a corporate venture fund or a venture studio? I actually believe that the best outcome, and you don't see this happening very often, that venture studios and to a large extent corporate venture funds ought to happen outside of the walls of the large organization too. I mean, you think about 23 years ago when Clay Christensen wrote The Innovator's Dilemma. How do you solve this problem, right? Inside a big company, you do everything right, the company's still going to fail. The solution was innovate as far from your core business as you can. In most big companies, what that means is we'll go set up a team inside. We'll, put them in a corner of the office, or even give them a separate office, let them wear jeans to work. What I do act a little bit different. It's not far enough. It's not far enough from the core. And in most cases, most big companies can go much farther than they think. And I believe that, especially now in this world where everything, as I mentioned earlier, everything is more distributed and decentralized, this is a trend that's going to continue. It's foolish in the long run to assume that you can do these things inside the walls of the organization better than can be done outside.
Well said. So I think
and it might be interesting for people because I'd love to poke that a little bit, because I don't know that I mean, counter a little bit, I think, around on the the incentive side of things, and having to always sort of, I'll call get best world in class by being outside or something like that. And the reason I go there is I think as some of the people I've worked with, I've been broke, right? I've had $18 to my name trying to build a fintech thing, and I don't know that I worked any harder that particular day than when I had access to other kind of resources and capital. And I know other people like that have very low insight and they're motivated by something else. And so I think what I would challenge a little bit is, financial motivation is a major factor, and I certainly don't want to diminish that. But often, a lot of times when people are doing, they're pushing it because they're like, a lot of entrepreneurs are often just trying to solve a problem. They're offended by the problem and they're trying to solve the problem. And whether that's inside a big organization or outside, I don't know that's always the case, that you have to actually spin it out. At least that's been my experience in order to access some of that talent or get the motivations right.
Yeah, my view is it depends on how different from the core business that idea is. If there's a high degree of ambiguity, again, back to the learning versus execution question. If there's a high degree of ambiguity and the idea challenges the core business in some way, it doesn't mean it needs to compete or cannibalize the core business. It might just mean we prioritize customers differently, for example. A startup, if learning is involved, a startup's going to be better positioned to win. And in most cases, again, if it's further away from the core, the more independence that startup has, the better equipped it's going to be able to move fast. Now, I'm careful, that word independence carries a lot, right? Ideally, you're launching new ventures here that benefit in some way from their link to the big company, right? The whole idea here in co-creation and big companies launching new ventures is that big company brings something to the startup that helps it get to scale faster than it could on their own. That might be their first customer. It might be their distribution partner. It might be just the brand halo and association with the big company that helps that startup stand out in a crowd. But everything that big co contributes to the startup comes at a price and needs to be done deliberately. Oftentimes, what we see is it's just not thought through. The assumption is that the startup's going to benefit from, hey, use the in-house attorneys, or we've already got an HR system, you can hire employees through that, or whatever. That's very tactical stuff. But I think it's helpful if rather than beginning with an assumption or a default position that the big co should control, that the big co should dictate how that startup operates, which often happens just by default, you should actually start with the opposite and then say, what should we borrow or rely upon the big co for, and recognize the prices that come with those borrowings. It's sometimes it's worth it, but often it's not.
Great. So one of the things I think really interesting, given the breadth of companies that all of you work with, is you see a lot of metrics. You see success rates, where things go, et cetera. Can you talk about some of what you've learned from a data standpoint? And by that, I mean, what's the success rates you see of the co-creation models of these things that are built? What's the success rate of new ventures launched out of a venture studio? Would love to hear some of the data that you guys have. Or not.
No, happy to always take on that. So, I mean, what's how do you parse the data, right? So, because there's so many different ways to look at, so not to try to be wishy-washy. If you look at what I would say, for the most part for us, by the time we get something to what in our terminology would be an MVP, which is enough conviction that, us or the corporate partner should put at least $1 million just to use a starting point. $1 million, it's at the point where it's worth enough to put $1 million kind of thing. Our success rate at that point is pretty high, right? I would say. And, so if I were to think, I'm just thinking back over stuff over the past couple of years, you start getting like, 70, 80%. And when I define success, it means did we start something? Did it get customers? And was it accretive in value? Accretive, to Elliot's point earlier, might be that it found out that it was a really, it wasn't going to work, but it found the right investment that corporate should go make. So it may or may not have been a success as a standalone, but it identified a couple things that connected a few dots and found the way for that corporate partner to make an investment in something or acquire something that was not already on the radar. So I would take that as accretive value for the entity. So I mean, that's kind of one place where we sort of I would call it, look at it. If you go earlier stage where you're still ideating, sticky notes on the wall, and I know there was a question, I think earlier in the panel, somebody asked about hey, too much ink, too much sticky notes. If you sort of go, but if you go into that kind of stage of where you're still ideating, it gets harder. It all depends on how it's trying to be measured, but certainly our model and our philosophy around it is when you think in terms of a cohort, I have a thematic area. Was my theme right? I see a trend coming, and is that trend going to lead to opportunities that this entity should be in? If you follow that approach and sort of stay in the thematic space and then think through what is the success of, I found a theme, I've now found a way to monetize and enter and play into that theme. Again, 70–80% sort of type of success rates that we would see in there. But to be super clear, if I started with a theme of X and where I ended up, you would not draw a straight line between those two things and say I started with X and I ended up at X plus 1.
Yeah, I'd second that. In our, venture studio model properly deployed, it can be very, very successful in terms of the financial returns it provides. And a lot of reasons for that. One is that there's so much vetting that happens prior to a launch. By the time we launch a new business out of our venture studio, it's survived a pretty rough gauntlet, right? There were, 100 other ideas that didn't make the cut, and this one, it got fine-tuned and refined, and by the time it gets to launch, we're pretty confident in its ability to go. And then secondly, post-launch, there's so much support, right? The network these things jump into is remarkable, and the founders in these companies get a lot of help. The studio provides not only the back office, but the idea about the whole thesis behind a venture studio is that a lot of the stuff these companies do is repeatable and not value accretive necessarily, right? If you can help the CEO focus entirely on understanding their customer and building a killer product, getting as quickly as possible to product market fit, everybody's gonna be better off. So if we can take away some of the things like negotiating leases and figure out which payroll software to use and all these things that fundraising, even to an extent that CEOs get bogged down in, we can create more value faster. And that's why a venture studio is very effective. We see our companies in our studio raise subsequent funding rounds faster and at higher valuations than their peers out in the wild. Now, the question in a corporate setting, there are different considerations. I think it's not just about financial return. And I think the objective of a venture studio approach in a big company should be about driving learning and optionality. In other words, a venture studio works really well for the types of ideas that fit in the kind of this thin band of things that I would say are not strategically critical, meaning if it's strategically critical, you should be doing this inside the company. You should be going and making some big acquisition. If the future of the big business is reliant on this thing succeeding, don't go build a startup. That's not the way to do it. A venture studio is better off looking at these things that are strategically interesting, areas where the big company needs to get smarter and to learn and to build options in preparation for a range of unknown futures. We don't know what's going to happen. The companies that are going to be resilient and survive the long term are going to have lots of options. Building startups is a good way to create optionality. And so there's that learning and optionality should be the primary goal. Now, if you can also do that, making good financial returns, all the better. And I think a venture studio model can, if done properly.
So let's talk about buy-in and how that comes as you're going through the process and everything. One, let's talk about what's the biggest hurdle to get that go, no-go decision for something that you really believe in, and how do you get that aligned up through the ranks?
I mean, in our case, since and again, we're nascent in this, but let me bifurcate between within a corporate structure versus not. So M13 independently also does quite a bit of research on white spaces and looks. One model is we look for white spaces, and if we don't see a ton of investable companies there, but we have strong conviction around it and feel we're actually solving a problem, then we think that warrants actually recruiting for and putting resources behind. It's not dissimilar to the process you would find somewhere else, which is where do we have strong conviction in those areas. And we've done it differently. In the case of P&G, they came to us with really strong IP and ideas, and it was developed from there. And in the case of PepsiCo, it's a bit different. They came to us with actual innovation areas that they wanted to develop. And so we're actually in this process right now. I can report back in a couple of months kind of how we've approached this. I'm keen to hear what Jason and Elliot have to say, obviously from their experience. But what we've done is at least aligned on the signs and the rubric around where are we aligned? Is this worth building? Do we agree on the frameworks and rubric, and created our own tools internally to really define if they warrant further pursuit, right? And I think it would be around the things that you would expect, right? Is this opportunity large enough? Is this aligned to the mission and the areas of innovation that the corporate partner is looking for? Most importantly, is there passion from the founders, right? Are they keen to actually work on these areas themselves? Is there, I think a bit to what we were talking about before, is there a line of sight to investor appeal, right? Is this something that we can validate externally in the market that people feel would be investable? And can we actually properly create and validate this product concept, and to Elliot's point, really create optionality to give it its best chance of success? I mean, those are the things that we've come together on and collided with our corporate partners on. But I'm keen to hear, I know since we're new to this, so we're making the sausage right now for those, so it's a bit messy. In terms of how we do it, although it seems like we're always sausage making all the time, aren't we? Jason and Elliot, I'm keen to hear how you guys think about this as well.
Oh, we're doing lots of sausage making too. I think the model's so new still, everybody's figuring it out. And every day we're learning new things about how to do this and how to do it better and differently, and the range of options for how to pursue it. There's nothing I'd say is gospel in any of this yet. Like, and the fun thing about that is I think there's so much innovation in the way that big companies innovate, in particular around this model. It's a really fun space to be in right now for that reason.
Yeah, I think this would be more of almost like switch to like a therapy session for everyone who's out there. It's like, you're not alone. Every one of our clients has that question of, how do I get the management buy-in? I'm struggling with getting this person or the other stakeholder, and it is the challenge, right? It's the hardest thing. I mean, how do you get somebody to think about putting in a fire hydrant, down the road when they're trying to put out their fire right now? You don't. I mean, the people mentally can't shift to those things. And that's a lot of what we do and the people we work with are trying to do, right? They're talking about, we need to have a fire hydrant for that future fire, but organizationally, they're not there yet. And so I mean, but to take that into practical tips, or how do we actually see, things that people can action on, the things that the organizations that we've seen have done it better or have gotten better through trial and error are being super clear about like what business unit this will go into eventually, who could be the stakeholder for this if it's going to go back internally, right? Like, so making sure that person is on board earlier and briefed in, and not, so that they're not surprised later on, spending a lot of time understanding where, like, and even like interviewing some of the more senior leadership, like president level of divisions, to understand like what's the stuff that keeps them up at night. We did some work with Diageo, we do a bunch of work with Diageo, and like, it's funny, we had, we were focused on all these things, and we had dinner with one of the senior executives there, and he told us the 3 things that he was terrified of that were a couple years out, and those weren't where we were focused. And so it was like, okay, we had sort of heard these whispers over here, but this senior person is actually seeing some other space. And so by getting that intel and aligning, we come back a year later, it's much more in alignment with what he is worried about disrupting his business in the next couple of years in that particular case, or her. And so that'd be my feedback, would be like, interview your senior stakeholders. I guarantee you, the senior people in the organization and like board members and key investors are terrified about where disruptions come, and they have opinions. And if you can find some of those and look around there, you can align to their kind of interest in it. And then it is finding some of the internal stakeholders. It's politics. I mean, it is at the end of the day, you have to do some of that work. So.
Can I add something really, really brief to this on a point I learned years ago, being inside, trying to run a corporate ventures team. The mistake we often made, and I see this often, and this didn't occur to me till about a year ago, when a corporate partner we were working with pointed it out, and the light bulb went on. So much innovation inside of big companies is funded from the P&L. And what I mean by that is to take a tax from different operating businesses and essentially say, we're going to fund innovation this way. And even if intentions are good, what happens is that innovation, that new thing, is held to the same standards that other uses of that capital are held to. So you might have a little bit of freedom, breathing room for the initial 12 months, but pretty soon people are going to be asking questions, well, when are we going to see a return on this? How much revenue are you going to generate next week? These types of things. And if you are working inside a big company trying to deal with these issues, I've found it almost a magic trick, if you can pull it off, is to figure out a way to invest in innovation from the balance sheet rather than the P&L. And what this does is it enables you as an organization to launch new things that don't have to be capital efficient in the near term like the operating business does. and they can get set up. They can work in the same way that startups do out in the wild that also don't need to be capital efficient in the near term. They need to be capital efficient eventually, but in the near term, the focus is on learning and finding product market fit. That's why we think external ventures are a good way to do that, because it's a natural kind of vehicle for doing balance sheet investment in innovation.
Perfect. That sounds wonderful. So, so one of the things that was kind of asked by one of the attendees was, the Capex is not trivial when it comes to building a venture studio. And, somebody made the point earlier that what you're doing today is growing the business, not necessarily thinking 5 years, 10 years down the road. How do you get that balancing of today versus tomorrow?
Right, Dave, I think that kind of goes back to that question before of stakeholders and putting out the fire here and short-term budget cycles. And, all of our partners work on 12-month budget cycles and have to go request funds. That's the harsh reality of corporate cycling, and they're planning now for the next fiscal year and stuff like that. That's a reality of what we're dealing with. And I think a little bit to Elliot points and Lizzie's point, a little bit sometimes spinning things out makes more sense, because you can have a multi-year cycle, you can have a multi-year thinking. I guess what we would strive for, and we would reiterate, is the model or the belief that we have as you start to adopt more of like a venture capital and like a 7 to 10 year fund type of view, going to the point if you're coming off the balance sheet and you're investing in that way, it gives you that time horizon to be able to sort of like look at this as a balance sheet type investment across a thematic area or a space, versus I'm plowing money into this one thing today in my near term budget. And so it's a tension that's always there, but that's certainly where we try to end up with our partners as things grow.
Yeah, I'm in agreement with Jason on that one. It is about rooting it in that longer cycle, and then setting up the appropriate milestones along the way.
And I might push back on the premise too that the operating budget for a venture studio isn't trivial. Actually, relative in the scheme of things, it can be pretty small. If you think about, one option to innovate, change the company, is to go do $1 billion acquisition. Depending on how much innovation you need and how soon you need it, that might be the right thing to do, but it can also be highly risky. Now, if you need to go learn, and you need to go learn a lot about a space, another way to go do a $100 million acquisition, right? Buy a single company and learn about a space, or go launch 20 startups for the same amount of money or less, right? So I would push back on the idea that it can be expensive, but relative to other options for transforming the business over the long term, it's actually pretty efficient, or can be, relative to that risk return measures.
Yeah, I think that's a fantastic point, right? If you think about the risk and returns on investments in one of our partners in the spirit space, right? We were doing some work with them around home experience a couple, year or 2 years ago, right? Little hobby project, learning a little bit. They probably $500,000, $750,000 into that kind of space around some stuff around in-home experience. Invaluable 12 months ago, right? Literally the entire business overnight had to figure out in-home experience when the hospitality space is shut down. And so if you look at the ROI of, in the scheme of like, for $750,000 for a business that does $40 billion a year, best return, not best, but a very good return, but would have looked really silly otherwise. And who knows, right? And that's this point of like, disruption comes from all these directions. And so I completely agree with Elliot. Like, if getting hung up on a $500,000, kind of learning and investment when you're a $40 billion company is just really short-sighted, right? In our opinion. And if it's, anyways, I could go on forever. I'll stop myself.
Yeah, we call them call options. Building new ventures, they're like call options on the future. You think about a portfolio of investments. You buy a bunch of call options because you don't know what's going to happen. These are call options on the future for a big company, and should be treated and thought of that way.
Yeah. So while I agree with you, I'm going to push back for you guys to give tips to the audience, because if you're, somebody leading innovation, you're a mid to senior level, how you might believe that, but what if your CEO, your board of directors, in particular, your CFO does not? So how do you get that stakeholder buy-in for corporate innovation when they actually see it as a big budget, that anything that's 7 figures, they're not making the comparison to spending 100 million or $1 billion. So how do you get that buy-in and help them overcome those hurdles?
The very best way I've seen this done inside a company is it started with a discussion around what is our objective as a business over the next 5 to 10 years. Setting the goal. Okay, the CEO said we need to grow our revenue by $10 billion over the next 10 years. Okay, we're all in alignment on that. And then breaking that down. How much of that revenue is going to come from our existing operations? Well, if we do nothing, we continue the business as it is, we're actually going to see a decline. Okay, so the gap's not 10 billion, it's actually 12 billion. How much of that's going to come through acquisitions? How much of that's going to come through better marketing programs and so on? You can start to tabulate it. Always, when this is done, there's still a gap at the end. And that gap's pretty significant when people actually look at it and stare at it on piece of paper. You might find, boy, that we're left with a $4 billion gap that somehow magically is going to happen through innovation. We wave our hands at it, but actually getting everyone to agree on what that gap is and how much of that gap needs to be solved through innovation helps when you're comparing against the investment that's being made to solve it. If you're trying to build a $4 billion of new revenue with a team of people working on it part-time and a $10 million a year investment, you're not going to build the next Google, right? With 10 part-time people and a few million bucks. So you either need to change the objective or you need to change the level of investment. And by articulating what that gap is together and putting in the language of the CFO and the executives whose primary job is capital allocation, you can start to assess whether or not the current investment is appropriate or not, and whether the portfolio of tools that we're using is the right set of tools to fill that gap.
Yeah, I think that's a really thoughtful way to put it. You know, like as you're building that layer cake of solutions for that gap, right? And I do think this is where it's where you can. What's great about this, even if it is there's a longer term horizon. There are a lot of indicators, both quantitative and qualitative, that you can feed back to your partner that they can then communicate back on, right? This isn't some like theoretical, can't tick and tie anything back. You can show pretty clearly how that layer cake is building as you're doing this together. So back to this sausage making idea, like you really can count the sausages while they're being made and bring that back as a supportive role for those who are lobbying internally to show how this is, again, building up that layer cake for success.
So final question for the group is one coming from the audience of talking about distributed team models and, keeping something separate versus keeping it close to the corporate headquarters. Lizzie, I know you've experienced with P&G and P&G Ventures and, what you've done in LA. And then Jason, Elliott, a lot of your clients aren't in the cities where you're based. So how do you think about walking that through with a corporation of what should they have in their city? What should they have remote? And how do they blend all of those models?
Well, so I'll take it from the co-creation standpoint. I think just as final question, I'll say that I know there's a bunch of questions we didn't get to, so maybe offline the three of us can huddle up and we'll get like some replies that Stu and Radicle can send out, because there's a lot in there. We'd love to take them all on. So for the audience, we'll try to get to all those and get back to you on them. To this question at hand of like team structure, I would say like, for us, we're looking at like how do we get access to the internal talent, the internal insights that will help this creation be a success. So whether that's deep fintech experience because it's a banking thing, whether it's switching, mobile switching things because we're doing something in the telco space or wherever we're working. So I guess simplistically, we're not geographically constrained. We think there's a lot of value to having distributed teams. We get a lot of flexibility by being able to spin things up very quickly and sort of being outside there. And certainly the past year in our minds has only reinforced that, that you can do innovation with people in 12 different time zones, right? And it does work and it is effective. So I guess the short answer from us is like, I just want access to the talent, the internal talent, the external talent. I don't really have a strong opinion where they are. So.
Yeah, look, I think certainly this past year has shown that a distributed model works. I think part of the magic, though, of the beginning is when you can be together and collide in a more frequent way. I mean, if it were up to us, pandemic notwithstanding, we like to be together. We like to collide in all parts of this with both partners and founders in entire space. But I mean, we've made it happen. We just launched our first remote cohort with PepsiCo, and it completely changed the way we thought about recruiting founders. We were not limited to LA. We actually had the entire United States to play with. And the experiment was, could we bring people from disparate places together and they would effectively collide? And the answer is yes. We're seeing it happen. And in fact, these people might never have collided if not for this. And so again, I just think it gets back to this point of diversity creates better outcomes. And so if geography is part of diversity, then that's, we've solved that this year, right? And we've shown that the model can work in many ways.
Wonderful. Well, perfect. That brings us right up on 3 o'clock. Stu, I'll turn it over to you because I know some people had questions about shareable recording and Q&A and everything else. So.
Yep. Thank you, Dave. So we will share a recording of this webinar with all registrants. We will share a set of highlights with those who registered as well. And then, further to Jason's point earlier, we'll try and get some of these other questions answered, noting that we had dozens of questions from the audience. So we'll try and get as many of them answered as possible and then share them with the group as well. Well, thank you, Dave. Thank you, Lizzie. Thank you, Jason. Thank you, Elliot. And thank all of you who attended, and look forward to seeing you next time, and have a great afternoon.
Thanks for having us, Stu. Appreciate it.
Take care all. Bye.
Thanks all.